This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, we've packed a number of shows together to give you some highlights. I know you're going to enjoy the show. Thank you for being with us today. Our guest is Pam Sacramando. Thanks for being on the show, Pam.
Thanks so much for having me, Whitney. I'm so excited to be here.
Entrepreneur Pam Sacramando is the founder of the C.R.E.A.T.E Wealth Network, the #1 free educational resource for commercial real estate investing. Officially retired, Pam discovered the ability to become job optional through passive income after realizing she did not need to be a millionaire to begin investing in commercial real estate. An aeronautical and mechanical engineer by trade, having been employed by Lockheed Martin, Boeing, and UTC Aerospace, Pam made a career pivot almost 10 years ago and founded her first multifamily acquisition and investing company, TPK Properties. Pam, welcome to the show. I'm looking forward to hearing just how you made that transition. That's such a big deal to transition from a career like that, into say an operator or passive investor. And it sounds like you've done both. And so look forward to hearing a little about that and just how you talk about becoming job optional. It's so interesting. And so, but get us started about who is Pam and let's talk about that transition a little bit.
Sure. Yes, definitely not a conventional path, I believe. So as an aerospace engineer by trade, I worked for those big name companies and I really enjoyed the technical work that I was doing. But I started realizing as I was getting promoted, moving on up, the work was coming in, but I was having less time to myself. So I realized that I was trading a lot of my time and effort for the money. And I was beginning to think, gosh, maybe there has to be a different way to kind of diversify my income streams. And that's what really began my journey into what would eventually allow me to arrive at my job optional status. Was I started researching different ways of investing. And the first book I read was Commercial Real Estate Investing for Dummies by Peter Conti and Peter Harris, one of my favorite books. And I had Peter Harris, who became my mentor, and he taught me and helped me to acquire my first deal. And so after I secured that first deal, I thought, wow, let's do this again. It was so fun. And then the common misconception, at least I know I had going into it, was I thought I had to be like a millionaire or, billionaire. And the fact was that I didn't need to do that. And that's kind of the beauty of syndicating deals. And so I was able to quit my job, my full-time engineering job, in 2 years after acquiring 3 properties, syndicating them between my friends and family. And that's kind of the beginning of how it all started. So now I'm just happy that the passive income comes in like clockwork, the rental income. And I'm just here to now spread the word on that it's possible, especially more than ever of just a rough year it's been. I really want to help, especially women as well, to understand that you can get into this while you're working full time. It's not easy, but where there's a will, there is a way.
No, that's awesome. And I'd love to talk about that as well, because I know there's women listeners as well as men also that can benefit just from your ability to make that happen while also being a wife and mom and business owner while working. That's difficult stuff, right? Difficult to manage all those things, right? Spinning all those plates. A syndicator already has to spin many plates, but when you're a mother, you've got many things happening. And I know how busy my wife is, and we could not make it without her. And as hard as she works, there would be no way. And I can't imagine, if she was trying to be a syndicator at the same time. But you mentioned trading time and effort for money. And, time is our most valuable asset, right? It's right. That thing, you can't get it back, once it's gone. And so it's interesting just to think about that, as a listener, are you thinking about where your time is committed? And, if you're in that JOB, you have to spend it there. You don't really have that choice. And it sounds like, Pam, you realized that and you created an option. So you didn't have to have that JOB. But let's talk about those 2 years you talked about a little bit, syndicating 3 deals. Congratulations, by the way, on making that happen. And in 2 years also. But can you just speak to, the listener who is pursuing that, maybe in the middle of that right now also, maybe not to their first deal yet, but, maybe they are a mother, or, or a father, but you have that JOB and you're trying to make this business happen. just some of the difficulties that you can speak to and encourage them.
Yes, it's definitely is not easy. I recall I would wake up probably a couple hours before I had to head into work to work on my real estate investing business. And then during my lunch breaks or during the daytime breaks at work, I would be focused on that as well. And then when I came home in the evening, it was the same thing. And so that's kind of the one thing that I realized early on was as hard as it is, you have to just hustle as much as you can in the beginning, because Whitney, as you can probably attest to, a lot of the upfront work will become beneficial later on. It's setting yourself up. It's a system, right? So once you find that way that works for you and you set it up properly, then things will start to flow in. And so for me, the hardest part was definitely a lot of hours beyond my regular 40-hour work week. And to be frank, it was actually turning into a 60-hour work week already at my my job. And so I needed to find different ways to work around it. And thankfully, at that time, my husband and I, we were, he was my fiance, and he fully supported me. And I think that's something that a lot of people don't often talk about, but it's the support network. That gives you the extra whether it's your religion, your family, your friends, that gives you the extra effort and energy to keep you going along that path. And I remember I was very upfront with him, and I said, I don't know if you're going to be in my life permanently yet, because I did not know if we were getting married or not. And I said, you're either in with me or you're not, and that's okay. But this is my path. And right now I need the support. And he took the back seat and helped support me throughout it all. And he wasn't demanding on my time in a sense. So if I had free time, I was so passionate about it, because I think when you have that first taste of getting close to buying your first property, or you're in the midst of exploring and learning, you get so excited. You just want to pour all that energy into it. And that's kind of what I'm doing now is I've decided to give back. I created the Create Wealth Network at www.letsgocreatewealth.com to provide free educational resources, because there's so many paths one can take, right, Whitney? For me, it's multifamily real estate, but we have others who might do storage unit rentals or single family homes or whatever have you in the commercial real estate umbrella, and to do syndications. But for me, that's what spoke to my heart. And I think I was very overwhelmed starting off. And so now that I'm gathering my thoughts here, I feel that, having that support network really helps out. I found a mentor as well. He was very instrumental in getting my mindset straight on focusing my network and growing it with intention and being mindful of who I'm talking to and how I can collaborate. And that really helped out a lot. But I think the hardest thing, though, when you are wanting to syndicate is getting that first deal down. When you get that first deal down, that's when the fun begins. And I say fun, but it can get exciting. It can get stressful as well. But truly, when you can close that first deal with working with other people and learning how to utilize, that raising capital, those skill sets that are lifelong, and also making friendships that are lifelong as well throughout the process, and bringing in a team of advisors to your wealth team. Like you said, you're spinning a lot of different areas as a syndicator. When you learn how to do that, oh gosh, it's just so rewarding to see that you're making everyone happy in the process, including your tenants, your investors, your teammates. Yeah. So in a nutshell, awesome. It's tough, but it is doable. And that's what I'm here for, is to help motivate everyone that even if you're working right now in your essential job, in the job that you need to have to pay those bills, you can still try to grow your passive income stream on the side. Just takes time, takes a lot of hard work, but don't give up. You can do it.
I think it's great that you bring up just your the support network that gave you that extra and talking about your fiance at the time or just family, because it's something I talk about when I'm speaking at an event or on a podcast, being a guest. People ask about that, and I'm like, I could not have done it without the support of my wife at the time and family. It was such a sacrifice for not only me, while working full time and making deals happen, working with investors, doing all these things. right? That, we're spinning all these plates. I could not have done it if my wife wasn't completely on board and supportive, because she was doing everything in the home, everything, while I'm working so many hours. So I can completely relate to that. And I just appreciate you talking about just the transparency, really, with your spouse. Like, this is what I'm pursuing, and painting that picture, right? I mean, they need to know, they need to be able to see that, the hard time that's coming, but also painting that picture of where we're going is important. And also, you found a mentor, so important. What about just any current misconceptions about multifamily investing that you see? You've been in the space for a while now, and on the passive side and as an operator.
Sure. That is actually a great question. And I started writing a blog on that, and I haven't published it yet on my website. But one of the main things I do want to focus on, the current biggest misconception I see, is that you have to have a lot of money. You have to be backed by a lot of money, or you need to be really well off before you throw down and buy that property. And that's just not true, because the sooner you learn how to work with other people's money and how to properly syndicate a deal, that in itself is a skill set that you can take anywhere, whether it's from a small deal to a large deal. And so that's the common misconception I get. And these days, a student outreach is at the heart of everything for me. And when I speak at colleges or real estate clubs, a lot of the students have that misconception of, gosh, I have so many student loans. I'm just trying to graduate. I want to do this, but I don't have any money. Where can I go get money? And the first thing I tell them is that, well, maybe you need more of the experience versus the money. The money will always come. When you have a really good deal, I am a firm believer in that. And knock on wood here, I haven't been proven otherwise with all my deals that I bring to the table with my investors and in talking with people. And so that's kind of a misconception to me, is that you have to be like a millionaire, bazillionaire just to be able to jump into this.
Are you a real estate syndicator or professional who is looking to grow your business in 2023? Are you tired of attending networking meetup after meetup and thinking that there has to be a better way? Have you ever thought about podcast guesting? According to Statista, podcasts are going to reach over 100 million listeners by 2024. Podcast guesting allows you to tap into that network of listeners. At Podcasting You, they have worked with hundreds of investors to secure guest placements on thousands of podcasts so they can raise more capital, generate brand awareness, and increase their credibility. If you're interested in learning how podcast guesting can help grow your real estate business in 2023, go to podcastingyou.com/syndication to book your free discovery call.
Dusten, excited to have you on. Thanks for joining us today.
Hey, thanks, Sam, for having me. I appreciate it. And I hope you're having a fantastic day. And I'm excited for this interview.
Yeah, definitely. I wanted to touch briefly on Mailbox Money and why. We talk about this often in the syndication space, this idea of passive income. But there's a lot of people, perhaps even listening to this show, that are somewhat new to this idea of money that comes in the mail on a regular basis. How have you leveraged real estate, achieve financial freedom for yourself and some of your clients as well?
Well, I've invested in a lot of buildings that pay me monthly rent, and I hardly have to do anything because I've set it up to be more passive. I got a really good team, a good property manager, and they know they know how I like to operate. I don't need to know about every little thing that goes on at the place. So it allows me to just do what I want during the day. Like, I'm busy all day long, but my schedule is wide open. Like, I can pivot and move. If an opportunity comes up, I can go and attack it right away. If something becomes very important, we can just focus just on that, because almost everything we do now is proactive. It's not reactive.
You make a lot more money, both for yourself and your investors, when you can move to proactivity versus reactivity. Having a plan, executing on it, and controlling for as many variables as possible is certainly a key to success. I noticed, Dusten, on your website, I was looking at some of the areas of the country that you invest in, and you're very well traveled. I think I wrote down you've got investments in San Antonio, in Phoenix, Atlanta, South Dakota. I mean, are you just trying to hit all 4 points of the compass, or how do you pick your markets that you're investing in?
So my markets are landlord friendly. So we don't really invest in any liberal cities. Plus, the cash flow in the bigger cities is less, and you got to be a more an institutional investor. And I'm just not at that level. And most of my clients aren't at that level either. They're just regular Joes that want to have more time freedom. So the Southeast is an excellent market. And then Texas, anywhere in the Midwest, I was told by some statistical guru that the Midwest is a 2-to-1 risk ratio. So the coasts are a much higher risk factor, which you can make way more money, but then you could lose more money quicker too. The farther in toward the middle you go, the less your risk is. And it's supposedly it's a 2-to-1 risk factor in the very center of the country.
Huh.
So we've got that covered from South Dakota all the way down to, Texas. And then we got the high appreciation in Phoenix and Atlanta, which is happening right now.
Yeah, that's very interesting. I've been doing quite a bit of homework on some of those upper Midwest states, your Kansas, Nebraska. I guess that's maybe center Midwest, but then on up into the Dakotas, which is where you're based. In South Dakota, your governor has definitely achieved some level of notoriety, but beyond just the headlines, what are you seeing there in that local market that excites you about South Dakota?
The demographics are really good and the metrics are really good. So it's a high cash flow environment over a high appreciation environment. And then we don't really participate in recessions here, I guess. They barely are blips on the radar. And you get high economic occupancy because everyone pays and they pay on time. There's a good work ethic. The farther north you go, usually the better the work ethic gets as well. But it's harder to raise rents, that kind of stuff. You can't get quite the appreciation, but it's very risk averse. So it's good to develop here because you don't really get caught in any boom bust cycles. And so I do some development here and then I invest passively down south. We got another deal coming up in Atlanta as well. Or not Atlanta, Orlando. Orlando.
Okay. So you're investing, maybe would it be fair to say more for appreciation in the Southeast markets and for yield in your home state?
Correct. But there's still great yield right now currently if you get on a good operating team, down south. So right now we're getting both, but the appreciation's been bananas.
I get this question a fair amount. I'd be curious for your thoughts, Dusten. We have a lot of different investors that invest with Life Rich Capital as you do. And different people have different goals with their investments. And some people are fairly new to investing in real estate. And so they're looking at all these different markets that you're in and different deal profiles. And they're wondering, what's the right deal for me? How do you explain the difference and what's some rules of thumb for investing in different markets you're exposed to?
Some rules of thumb? Well, I think niche location is actually more important than overall location as far as cash flow, because you'll always be high. You'll have high occupancy always. But location to me is pretty much everything. And then operator is after that. They're both super, super important. If you get a great operator in a great location, you'll make tons of money. Just as easy as that. If you get a bad location and a great operator, you'll still make good money. Even if you get a great location and a bad operator, you'll probably still make money. But if you get a poor location, poor operator, it's not going to be a good investment at all. But yeah, if you can, it's just the operator and the location. If you have those two things, you almost what else is there? I mean, you got to buy right and all that stuff, but those two things are, to me, by far the most important, because a good operator will figure out how to finance right and do everything right.
Yeah.
So
you've partnered with quite the collage of different operators. So you have some experience in kind of vetting, doing your due diligence on your investors' behalf. What are some of the tip-offs that you look for a good operator as you're looking?
That I can pretty much, you can trust your gut and find a good operator. I think the only way you really find a great operator is to actually put your money down and go through the whole process. And you need to go with multiple operators, because even your gut, will tell you a really good operator, but they just may be lacking this or that, or haven't found the right partner to fill that gap. But all of a sudden you'll find the right team that's getting off-market deals, like Zag Happenstall, the Rise 48 equity team. You'll find a team like that, and the returns are just completely outsized. And then the deals just come in and you get on their list. And then once you're on their list, then you can't get in after a while because it's too full. But you get on their list initially, and otherwise I don't know how you actually just go and find the best operator right off the bat. I don't know if that's possible. I think you gotta That's why I like to just bring in my own money on the new guys first. Like, if I find an operator that I like, I just put 50 down on one of his deals and see what happens.
Yeah. Well, and I think the Happenstall Rise 48, they're a perfect example. A lot of LPs that I talk to, they're like, well, I will only invest with somebody who's been through a full cycle. Well, you're unnecessarily capping your market. I'm not saying that every new syndicator that comes up or has started in the last 3 or 4 years is going to be the best thing since sliced bread. But ultimately, doing your due diligence, placing a little bit of capital and exploring what's out there could lead to outsized returns, especially if you pair a really good operator with a really good market like Phoenix, like a DFW, and some of the other markets that are really hot right now.
I'd say you're way too risk averse if you can't put 50 grand down to test an operator in a new market that you like initially off the bat. If you like them, they're going to be fine. They're not going to, I mean, unless they scam you or something, which I don't know. It's pretty hard with all the stuff you got to do and the way that you get approved for these loans and stuff. These guys are vetted pretty well. I mean, some people are scams, but it's not, from what I've run into, I haven't run into any of that stuff yet. So
yeah, it's definitely not as prevalent as as some people would have you believe. There's a lot of good actors in this space, but there's also a lot of mediocrity. I think that's your biggest enemy, is not the scam artist, but it's the guy who's just operating in a mediocre fashion. I know Dusten is part of a GP team that's taking down some of these deals. You bring kind of a design eye with some of your construction background, and something that you talk about on your website and in your LinkedIn content is wellness design. What is wellness design? And could you expound on what that means specifically for apartment investors?
Wellness design is very simple. It's a living quarters, dwelling, whatever you want to call it, unit that makes you feel better when you live. So it increases your wellness. And that's the purpose of it. Like, we design these things and it brings you to nature. Like, it's the dwelling is supposed to bring you closer to nature than another dwelling that's comparative to it. So the ultimate wellness design is usually in the middle of a forest, and it's like complete windows all around and everything's perfect and you feel like you're outside. So that's the goal, is to just bring you closer outside, bring you more outside, have the space more lit up, more bright, have good lighting. The flow is good as well. It's very efficient space. And then, usually you need a lighter palette with some raw woods, just real natural stuff. The colors that you see in nature, some plants, different things of that variety. But it mainly has to do with the windows and how you frame your surroundings.
And so when you're coming into an apartment complex, and much like LifeBridge Capital, you guys are focused on value adds. We're typically talking 70s, 80s product, perhaps a lot of garden style apartments. I'm not guessing wellness design was huge in the 70s, at least based on the complexes I've seen. What are some things that you can do to incorporate some of those elements and make the compound a more attractive place to live, attract new tenants, all those things?
You can over landscape. You can paint lighter palettes on the interior. You can expose the windows better. You can remove overgrown landscaping at the same time. Like, sometimes when you should remove the stuff that's too close to the unit, and it gives you a sense of space and it brings you a little bit more outside. It's pretty hard though to really incorporate wellness design into a really crappy design, but there are some things you can do, but it's a lot harder. It's better to start with something that has good bones. So you can also, when you're shopping apartments, pick ones that have better bones, pick ones that have better floor plans. Like, if you go in and don't want to live in those floor plans, there's a reason. It's just they weren't designed very well. So the better designed floor plan too, which is kind of wellness design, the better you'll have long-term tenants, and the longer you'll keep your tenants. Yeah. And it plays into the community aspect as well. Like, you want to have the coolest property manager. Like, you can't have anyone negative either on your staff. If the maintenance man's negative, that drives people away. So you got to train those guys as well, in my opinion. Yeah. But that whole thing is kind of all community based, friendly, kind, all that stuff, so that people are, good energy. So people are encouraged. They want to be at that place. Like, they want to bring their friends to that complex.
Yeah. What's interesting, we have 2 complexes that are pretty nearby one another, within maybe half a mile. very similar vintages, but one of them was designed, it was a 2-story apartment. The other one was 3-story, but the 2-story has vaulted ceilings and natural wood paneling in those second floor units. Makes a huge difference what you can achieve on a per square foot, your turnover, all those different things. Just attracts a totally different style of tenant and somebody who's typically willing to pay more. It has been somewhat eye-opening for us, the difference that a well laid out unit will make. It's not just all about square footage. So I'm curious, talking to a lot of operators that either were completely sidelined in 2020 or some that were more aggressive and got comfortable. We opted to take advantage of that historic spread between interest rates and cap rates because cap rates froze with fear in the marketplace. How did you solve that problem? Obviously, you were investing in 2020. You were placing funds and closing deals. What was that process like for you?
So there was a point where for 3 months where there was no deal flow. But during that time, I went and refinanced my entire portfolio. So I shaved a point off of all my existing loans and very minimal fees because the banks, like, there was so much capital sitting on the sideline. Nobody was buying anything. You could still refinance. And so the banks were like, okay. And they just negotiated down and it almost cost me nothing. And I reset my entire portfolio at one point. I don't even know how much extra cash flow that was. Massive, massive move. That was very easy to do. Just completely took advantage of the market. And then as soon as we were looking the entire time, because I've always been under the mindset that multifamily, if it's a deal, it's a deal. Like, when a deal's a deal, you can buy multifamily anywhere. As long as you're going to put decent debt on it and you're fine with holding it, you can buy multifamily. But if you want to sell in 3 or 5 years, then you might not be able to buy multifamily. But even 5 years, we've gotten through everything in a 5-year cycle. So, and then we finally started getting deal flow at the end of the year. And it was just like bang, bang, bang. And then everyone by then was getting deal flow again. And then we were back in the cycle. But I didn't take one day off. We also had a development that we stabilized. It actually worked out in our favor, probably, because I don't think we would have gotten that thing. I don't know if we would have gotten that apartment done. Like, COVID happened, and then we got all these additional people to come help us work. So we finished off the complex, and then everyone moved in. It was past the pause, and then everything moved in, and stuff started opening back up a little bit again. But yeah, that first 3 months was like nothing was really happening. But we just went to work and hammered out this development we're doing in downtown Brookings. So it was great. I never sat at home in a day. I actually was kind of jealous because we had such a tight deadline that I basically was working from 7 a.m. to midnight or something bullshit. And then, but we got it wrapped up. That's been a great project as well. We got a tenant in the bottom of the commercial space now. So we have that whole building is full now. So it's pretty cool.
So it was a mixed use development then in Brookings?
Yeah, mixed use, historical. I had to deal with the historical society, and it was a adaptive reuse. We set the building in through the old historical building. So we kept, the main floor was concrete, and we had to go through the floor with these little holes. And then down in the basement, we had to dig these massive footings, and they had to drill all these pilings. They dropped these little skid steers down there. They were moving around. It was crazy. And then we built this platform that sat above it, and then we tied that into the historical storefront. So we kept 4 walls in the floor. Otherwise, everything else got ripped off, and then we set this. And there was 20 units above. 20 units. And so then you have units right downtown, so then you get top dollar. It's that wellness design. It's all that stuff.
That sounds like a lot of vision required to pull something like that off. Dealing with historical structures is not an easy task.
No, but I always am like, there's got to be a way. I just don't think if you want to do it, you can find a way. So halfway through the project, I'm like, man, I'm an idiot. And everyone's like, I can't believe you're doing this. You're nuts. And then it got done and it filled up. And then it's like, okay, on to the next thing. But yeah, it required, I have some sort of vision. I probably should have been an architect, but actually I'm probably a better developer than an architect because I'm not good with the minutiae. I'm just good with the overall vision and getting someone to understand what I see. And if I can get the architect to see that, then they just take over from there. So it's pretty cool.
give them the 10,000-foot view and let someone else sketch out the details.
Yeah.
Yeah. That makes a lot of sense. I'm curious, going back, you said you refinanced your whole portfolio in 2020 during COVID. What's your debt strategy? Did you put long-term fixed? Did you go floating?
No, it's like so in between on long-term debt that it's just the 5-year. We just do the 5-year term, but we're not very, we go to the 80%, but everything cash flows really well. And they just adjust in 5 years, I guess. But the stuff I personally, asset management is right on the cusp where it's not really worth it to always go long-term debt. Plus then the fees, I don't know. I looked at a lot of people that got burnt on signing long-term debt, especially last year. Everybody had to hold through. Now some of them are able to sell, but like a lot of their profits are keeping them locked in. They have to keep that profit locked in there. They can't do anything with it. And if they want to exit, then they lose all their profit, goes to agency debt. So I still think we're in a really low rate environment. So until I see signs that it's going to go higher, then maybe we'll do something, lock in some longer term debt. Who knows?
Sure. Yeah. Everybody loves the siren call of non-recourse debt through some of your GSEs, but you got to watch your prepayment penalties because they can eat you alive. We've started financing more of our deals through some local credit unions simply because they'll give us 10-year fixed, really competitive with agency, but no prepayment penalty. And having that optionality, even if you don't end up ever using it, man, it's really important to have that different exit strategy and not be bound by yield maintenance or defeasance.
Well, and then the refinance, like it's just so much easier to refinance and take advantage of that refinance. Like if I was going to refinance on agency debt, I can't do that. I'd be stuck at the 5%. So yeah, just because it's non-recourse agency debt doesn't mean, and it's long-term doesn't mean it's the best.
No.
It is good though. I'm not going to say it's not good because a lot of our bigger deals have it. So it's still really good, but depends on what you're doing and then how much you want to be able to pivot.
Thank you for being with us again today. I hope that you have learned a lot from the show. Don't forget to like and subscribe. I hope you're telling your friends about the Real Estate Syndication Show and how they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing today.